Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ck Hutchison Holdings Limited annual report. Ck Hutchison Holdings Limited is a diversified conglomerate with a wide range of businesses and services across various sectors. The company's operations can be broadly categorized into four main segments: ports and related services, retail, infrastructure, and telecommunications. In the ports and related services segment, Ck Hutchison operates 293 berths in 53 ports spanning 24 countries, providing logistics and transportation-related services such as cruise ship terminals, distribution centers, rail services, and ship repair facilities. The company also invests in energy infrastructure, transportation infrastructure, water infrastructure, waste management, and other related businesses. In the retail segment, Ck Hutchison operates retail brands with stores offering personal care, health and beauty products, food and fine wines, consumer electronics, and electrical appliances under brands such as Watsons, Park Shop, and Fortress. The company also manufactures and distributes bottled water and other beverages under the Watsons Water and Mr. Juicy brands. In addition to its retail operations, Ck Hutchison provides mobile telecommunications and data services through its telecommunications segment. The company also operates as an integrated energy company, providing electricity generation and distribution, gas distribution, and aircraft maintenance services. Furthermore, Ck Hutchison engages in research, development, manufacturing, commercialization, marketing, and sales of nutraceuticals, pharmaceuticals, and agriculture-related products. The company also provides marine construction and ship repair yard, general engineering, tug operations, water supply and sewerage services, and leases rolling stocks. Overall, Ck Hutchison Holdings Limited is a multifaceted conglomerate with a diverse range of businesses and services across various sectors, including ports and related services, retail, infrastructure, and telecommunications. Ck Hutchison Holdings Limited market capitalization of $245 billion is significantly larger than the average industry peer of roughly $19 billion. This shows that Ck Hutchison Holdings Limited holds a significant advantage in their industry. Ck Hutchison Holdings Limited trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 0.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 41% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.61%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth are multifaceted and can be categorized into several key areas. Firstly, contracts with customers and considerations specified in a contract are significant contributors to revenue growth. Additionally, the provision of ports and related services, retail sales, sales of infrastructure materials, telecommunication services, other service income, share of profits less losses of associated companies, and share of profits less losses of joint ventures all contribute to revenue growth. On the other hand, the primary drivers of revenue decline are largely influenced by external factors. Lower than expected growth and reduced projected service revenues from 3G and 4G services in Vietnam have been a significant driver of revenue decline. Other contributing factors include loss on disposal of subsidiaries, decline in trade receivables, decrease in contract assets, and decrease in other current assets. It is also worth noting that customer acquisition and retention costs may impact revenue growth, while industry development expectations can influence revenue growth or decline. Furthermore, revenue from Vodafone 3 contributes to revenue growth. Overall, the drivers of revenue growth and decline are complex and influenced by a variety of factors. Net income and profit margins have shown significant improvement in the recent period. Excluding one-time losses, net earnings increased by 7% to Ck $22,258 million. This increase is attributed to various factors, including a higher contribution from Cenovus Energy, which saw its net income rise by 24%. Indosat Ooredoo Hutchison also reported a notable increase of 12%, while TPG Telecom Limited experienced a substantial growth of 233%. Profit margins have also improved, with underlying EBITDA and EBIT increasing by 9% each. The improvement in EBIT is primarily due to the increase in upstream production volume and the recognition of a gain from downstream asset disposal. Additionally, Indosat Ooredoo Hutchison's improved revenue across all business lines and TPG Telecom's disciplined cost controls and 2% service revenue growth have contributed to the overall increase in profit margins. The reasons behind these changes are multifaceted. The higher contribution from Cenovus Energy has been a significant factor, as well as the increase in upstream production volume and the recognition of a gain from downstream asset disposal. Improved revenue across all business lines at Indosat Ooredoo Hutchison and disciplined cost controls at TPG Telecom have also played a crucial role in driving these changes. Overall, the improvement in net income and profit margins is a testament to the company's ability to adapt and thrive in a dynamic market. The company's ability to generate positive operating cash flow is a crucial indicator of its financial health. Based on the extracted summaries, there are numerous instances where the company generates positive operating cash flow. For example, on page 57 and page 141, it is explicitly stated that the company is generating positive operating cash flow. Additionally, pages 188, 192, 194, 196, 210, 226, 230, 262, 263, 294, 298, 300, 308, 335, and 337 all indicate a positive operating cash flow. However, there are also instances where the company's operating cash flow is not directly provided or is negative. For example, on page 191, it is stated that the net cash from operating activities is $47,760 million negative. Similarly, pages 264, 266, and 268 indicate a negative operating cash flow. Despite these inconsistencies, the overall trend suggests that the company is generally generating positive operating cash flow. The numerous instances of positive operating cash flow across various pages outweigh the few instances of negative or inconsistent results. Therefore, it can be concluded that the company is indeed generating positive operating cash flow in most cases. The company's debt level and interest expenses have undergone some changes over the past few years. In terms of debt levels, there was an increase from 2023 to 2024, followed by a decrease in 2025. However, it is worth noting that non-current liabilities have increased significantly between 2023 and 2025. In contrast, interest expenses have remained relatively stable, with no significant change between 2023 and 2024. The interest expense for both years was $12,083 million in 2023 and $13,392 million in 2024. This suggests that the company's debt level has increased, but its interest expenses have not kept pace with this growth. Overall, while there has been a significant increase in debt levels over the past few years, the interest expenses have remained relatively stable. The financial performance of various segments and regions within the company has been mixed, with some areas performing exceptionally well while others struggled. On the positive side, Europe and Asia, Australia and others have shown strong growth, with EBITDA margins reaching 20% and 27%, respectively. Canada has also experienced significant growth in both EBITDA and EBIT at 100%. The ports and related services segment saw an 8% revenue increase, while retail and Ck Hutchison Group Telecom reported 10% and 15% revenue growth, respectively. In addition to these strong performers, several regions have achieved notable recognition for their workplace culture. Italy's Windtree was named Top Employer Italy, Sweden's 3 Sweden received the Great Place to Work award, and Asia's A.S. Watson Group was recognized as one of the best companies to work for in Asia. However, not all segments and regions have fared well. The Chinese mainland has seen a decline in EBITDA and EBIT at -1% and -17%, respectively. Hong Kong also struggled, with an EBIT decline of 23%. Finance and investments and others experienced a significant revenue decline at -9%. Furthermore, the health and beauty China segment saw a substantial decline in EBITDA at -74%, while Chinese mainland's revenue decreased by Ck $138 million. Canada's revenue also declined significantly, from Ck $104 million to Ck $9 million. Overall, while some segments and regions have shown impressive growth, others have struggled with declining revenues and profitability. The management of this company is emphasizing the importance of balancing shareholder returns with stability and growth. They aim to achieve this through optimal capital structure management, which involves adjusting their capital structure in response to changes in economic conditions. In terms of financials, the company boasts a robust position, with a strong treasury function that effectively manages financial risks and provides cost-efficient funding. They also utilize derivatives such as interest rate swaps and forward rate agreements to manage their interest rate exposure and hedge foreign exchange risk through various instruments. The management is committed to providing returns for shareholders while ensuring stability and growth. This is reflected in their investment strategy, which involves making adjustments to judgments, estimates, and assumptions to ensure the carrying amount of investments accurately reflects their value. Overall, the company's focus on maintaining a strong financial position, managing its capital structure effectively, and providing returns for shareholders while ensuring stability and growth suggests that they are well-positioned for future success. The acquisitions and divestitures made by the company are significant transactions that have shaped its business landscape. On the acquisition front, the company has made several notable deals, including the merger of UK telecommunications businesses with Vodafone UK, the acquisition of Meg Energy by Cenovus Energy, and the purchase of a 49% stake in Vodafone 3 for HK $40,766 million. In addition to these major acquisitions, the company has also acquired various subsidiaries and non-controlling interests, as well as made partial disposals of its subsidiaries. These transactions have contributed significantly to the company's growth and expansion. On the divestiture side, the company has sold several assets, including UK Power Networks to Enjoy SA, a 70% interest in UK Rails, and tower assets supporting mobile businesses in various countries. The company has also made partial disposals of its subsidiaries and recognized put option liabilities over non-controlling interests. The disposal of subsidiary companies has increased the group's liquid assets, while the transfer of gains on disposal of equity securities to retain profit under previous GAAP/IFRS has resulted in a negative impact of Ck $126 million. The concurrent acquisition of a 49% stake in Vodafone 3 and the disposal of 3 UK have also been notable transactions. Overall, these acquisitions and divestitures demonstrate the company's strategic efforts to expand its business, optimize its operations, and increase its value. The company's financial history reveals a consistent commitment to rewarding its shareholders. As evident from the provided references on pages 313 and 321, it is clear that the company has indeed paid dividends in the past. This indicates a strong focus on shareholder value creation and a willingness to distribute profits back to investors. Supply chain disruption, a growing concern. The current state of global trade is marred by several factors that threaten to disrupt supply chains worldwide. One such concern is the reduction in ports operations throughput due to factory closures in China, as mentioned on page 60. This development has significant implications for businesses that rely heavily on imports and exports. Furthermore, page 61 highlights a range of disruptions caused by various external factors, including political unrest, terrorist attacks, military tensions, climate change, and currency fluctuations. These events can have far-reaching consequences, impacting not only the flow of goods, but also the overall stability of global trade. While there are concerns about supply chain disruption, inventory buildup does not appear to be a pressing issue at present. As noted on page 312, inventory levels and working capital are being managed effectively, without any specific mention of supply chain disruptions. However, it is essential for businesses to remain vigilant and adapt to changing circumstances to mitigate the risks associated with supply chain disruption. That concludes the financial summary for Ck Hutchison Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.